Chat GPT, that nifty AI tool many of you use to pen horribly written articles on subjects you're too lazy to research yourself, can be a really great way to survey the sentiment of a topic, at least as it exists on the internet. So, given that, I decided recently to ask Chat GPT to give me the top 5 reasons someone should avoid whole life insurance. The results, they're kind of interesting. First up, for reasons we should avoid whole life insurance according to ChatGPT is, unsurprisingly, cost. According to ChatGPT, whole life insurance premiums are typically higher compared to term life insurance premiums. If your primary goal is to secure coverage for a specific period, such as until your mortgage is paid off or your children are financially independent, term life insurance may be a more cost-effective option. Now, there is certainly no doubt that if we're trying to secure a certain level of death benefit and we're trying to do it for as little premium as possible, term life insurance is going to win, at least today, on that topic. And when I say today, I mean right now. So if you're buying life insurance, you need death benefit right now, let's say $1 million, term life insurance is going to, for now and for several years into the future, going to be less premium than whole life insurance is. Simple. No argument here. But this critically overlooks many of the features, the benefits, the additional things whole life insurance brings to the table that you don't get when you buy term life insurance. It also does not address the fact that many people will go into later life stages with a need for life insurance, or at least a desire to have life insurance. This could be something like Social Security is going to play a big role in your retirement income plan. Maybe you and your spouse are both going to contribute income to the plan based on your Social Security benefits. If one of you dies, you're going to lose that spousal benefit that spousal income, and now you may have a shortfall. Life insurance could be incredibly important in this circumstance. You may also discover that owning whole life insurance into your old age may provide an ability to transfer wealth that is much more simplified than transferring an IRA or trying to transfer money out of a brokerage account or your savings account at the bank. Life insurance passes through a beneficiary designation automatically to your named beneficiary, and it goes income tax free. So this eliminates any sorts of worries of disequal inheritance based on different socioeconomic achievement of your children, and it also makes the process seamless because they don't need to show up with any sort of additional information. They don't need to execute any sort of probate protocol in order to move money. Life insurance can have some benefits to this, and term insurance could work this way as well. It's just most people are not going to own a term life insurance policy when they die because they're absolutely designed to go away prior to death. Additionally, this overlooks all of the things that one might use whole life insurance for that have not as much to do with securing death benefit, though that is usually on the table, but also some of the things that whole life insurance may bring to the table from a wealth building perspective. Yes, it's going to require a higher commitment of money going to the whole life policy than would be the case for term life insurance if you're just buying death benefit. And if you're just buying death benefit, that's the case where term life insurance is indicated. But on its own, this argument is taken very much out of context because there's a number of things someone might use whole life insurance for, and cost is kind of a foolish thing to discuss in that context. Yes, term life insurance will get you more death benefit for less premium compared to whole life insurance in most cases, but there's a whole lot more to this discussion that you may be overlooking. Additionally, let's not overlook the fact that term life insurance, or companies that sell term life insurance, the ones that have those whiz-bang quoting engines that you can fill out online and then be hooked up with an agent, have for years marketed their services through affiliate programs, which means they pay bloggers and other financial press sources a commission every time they generate a lead for them. There aren't any whole life insurance brokerage companies that are offering that sort of feature or service, so they don't get talked about, and they get talked about in sort of negative terms because lots of people who write these blogs need to monetize somehow, and they'd much prefer that you jump into the term life game and fill out their quote engine. Next up on the list, investment returns. So, according to ChatGPT, whole life insurance policies often include a cash value component. They always include a cash value component, but anyway. That is meant to grow over time. However, the returns on this investment portion can be lower compared to alternative investment options, such as mutual funds or other forms of savings. If you're looking for higher returns on your investments, separate investment strategies might be more suitable. This one's a little weird because while ChatGPT does not specifically call out the stock market, it is kind of insinuating it through virtue of mentioning mutual funds, which most people tend to associate with investments in the stock market. Listen, there is zero argument from me or anybody who's reasonably well equipped with knowledge on this subject that the stock market is going to outperform the rate of return we would expect on the cash value accumulation of whole life insurance. That is not why we're buying whole life insurance. Whole life insurance is, at its best, a wonderful store of cash-like funds at a rate of return that is better than cash-like instruments with tax benefits that those other vehicles will never be able to touch. Additionally, because of those features, it makes it a really great alternative to owning bonds, simply because bonds have a certain amount of liquidity issues and can fluctuate in value in a way that whole life insurance never will. But whole life insurance is not something we would get into if we're looking for stock market-like returns. It's not going to happen. It's never going to happen. And yes, there are some people on the fringe out there who have tried to make all sorts of crazy arguments about net after-tax rate of return to compare to the stock market and suggest that whole life insurance will ultimately net out more. It's probably not going to happen. But when we take whole life insurance in the context of what it's reasonably compared to, cash and bonds, and we look at what it can achieve from a year-over-year rate of return, growth-wise on the cash value inside a whole life policy. Plus, we look at all the things that we can do with whole life insurance, like take money out of it through withdrawals or loans at any time with no consequences because of our age. The fact that these do not carry income tax liabilities with them in most cases, and the fact that we can leverage the dollars inside a whole life policy that will continue to grow even when we take a loan against it, we start to have a product, we start to have a financial tool that has a lot of robust opportunity that we can take advantage of. But in an outright drag race, rate of return comparison against the stock market, it's not going to win. It doesn't have to win. Diversity is a great thing. We always buy different assets with an intention to diversify various types of risk. So owning some degree of something like whole life insurance and stocks is a great way to benefit from what stocks can provide, while also hedging against losses that might happen in the stock market because whole life insurance is contractually guaranteed to continue to rise every year. But no one is going to get rich simply putting money away in whole life insurance. You may build a decent cash position. There may be certain things about you and various habits you will form by virtue of buying whole life insurance that will put you in a better financial position than you would have been otherwise. But you are not going to become an overnight millionaire by virtue of buying whole life insurance. You're probably not going to become an overnight millionaire by buying stocks either, but the chances are at least higher. The simple point is this is not an us versus them situation. You don't buy stocks instead of whole life insurance because the rate of return is higher. You buy stocks because stocks are stocks and they offer something that whole life insurance does not. And alternatively, you buy whole life insurance because whole life insurance is not stocks and it offers something that stocks do not. The rate of return on whole life insurance is extraordinarily good relative to its risk profile. And you are never, ever going to dig yourself out of a financial hole by trying to up the ante of your risk profile to get a better rate of return long term. It does not work. Okay, number 3. This one's a fun one. Complexity. Whole life insurance policies can be complex with various features and riders. Understanding the details of your policy, including how the cash value accumulates and the impact of fees, can be challenging. If you prefer a simpler insurance solution, term life insurance might be a better fit. So in other words, Chat GPT thinks you shouldn't buy whole life insurance because you're too dumb to understand it. Look, I'm not going to tell you that whole life insurance is the simplest financial product out there, but I also don't think it's anywhere close to the most complex. I get that there's a certain amount of nomenclature to whole life insurance or life insurance contracts in general that may be a little intimidating to the layperson, but this is true of any circumstance you may find yourself in. So the ability or the need to learn the pieces and parts is not a reason not to do it. It's actually a reason to have an intellectual pursuit and understand what's going on, and then make the decision whether or not you want it. But looking at it simply from the standpoint of, oh, that seems too complicated, I shouldn't do it, it's never been an acceptable answer, at least in my book, to look at a circumstance and say, that's just too complicated to do or understand, so we're not going to do it. I at least have a desire to figure things out as best I can and then make a decision from there. If you don't share that sentiment with me, well, that's you, and you do you. But I know of a lot of people who have figured out, at least to a certain intermediate level, what whole life insurance is all about, and they love it. And while term life insurance may be easier to understand, at least superficially, there's a lot of consequences to owning term life insurance that aren't so easily understood at the beginning that may result in some serious frustration and ire as time goes on. Number 4 on the list has to do with flexibility. Again, according to Chat GPT, whole life insurance policies may lack flexibility. If your financial situation changes and you need to adjust your coverage or premium payments, it can be more challenging with whole life insurance. Term life insurance policies often offer more flexibility and can be tailored to your changing needs. I hope you're all catching on to a trend here. So this statement is wrong. Purely wrong, just wrong. There is a ton of flexibility and versatility to whole life insurance. In fact, way more than you will ever get from a term life insurance policy. Keep in mind that when you buy term life insurance, the majority of the policies, I'm talking like 99% of them out there, will have you select a death benefit, which will give you a corresponding premium. But that death benefit must be selected under a guaranteed period. So 10, 15, or 20 years being the most common options that you have for you. You choose, let's say, $1 million death benefit, 20-year level period, which results in, let's say, a $500 a year premium. Sounds great. What that means is for the next 20 years, you can pay $500 a year and have a $1 million death benefit. For a lot of these policies, you might have the option to reduce the death benefit, which would correspondingly reduce your premium. You will not have the option to increase the death benefit. And for the majority of these style term products in existence, after 20 years, you will lose your coverage. Some of them will allow you to continue coverage with a much, much higher premium. A lot of them, however, will simply terminate with no option to continue coverage. Whole life insurance, on the other hand, will definitely require a significantly larger premium. Say $1 million death benefit may cost somebody who could pay $500 a year for a term premium, probably something more in the neighborhood of $5,000 a year for a whole life death benefit. But whole life insurance comes with the option to definitely reduce the death benefit, definitely keep it longer than 20 years, and also many whole life products will offer the opportunity to increase the death benefit over time. Additionally, if you can't make the $5,000 premium, again, hypothetical, then you may likely have some options to skip the premium without losing your coverage. In fact, it's story time. I want to tell you about Becky, the property manager. Becky bought a whole life insurance policy off me many, many years ago. In fact, when I was much younger, much less skilled, and really didn't know that much what I was doing. But luckily for her, she made the right decision at the outset because a few years after purchasing the policy, she stopped paying her premium. Why? Because life got in the way and she didn't have the money. What happened to her policy? Absolutely nothing. It continued to remain in force because the cash value that had built up inside the policy covered the premium for her, relaxing her needs to come up with the money to pay for the whole life policy. Had she owned term life insurance and couldn't pay the premium, the policy would have ended because when you don't pay the premium, term policies go away. Did you know that all life insurance agents have the ability to design a whole life policy that has flexibility of the premium, allowing you to reduce it or bring it all the way to zero if need be in any given year of the policy's existence? Did you know that you can put a whole life insurance policy in force that has a finite number of years you have to pay the premium and then it's paid up guaranteed forever? Did you know that all whole life policies come with a contractual provision that will allow you to make the policy paid up, force it into paid up status? You will lose some death benefit, but you will keep your policy in force forever and always, and no one can take it away from you. Did you know that dividend-paying whole life policies can and usually do arrive at a point where the dividend can pay the premium so you don't have to? And did you know that you can sell a whole life insurance policy if you decide you no longer need the death benefit? You'll receive something that is a value in between cash value and death benefit as a buyout offer for the whole life product. None of these are things that you can do with term life insurance. So simply, the claim that term life insurance is somehow more flexible to changing financial needs than whole life insurance is simply wrong. Okay, last one on our list is admittedly a bit of a weird one, but here we go. We're going to call it insurance versus investments because that's what Chat GPT called it. Whole life insurance combines insurance coverage with an investment component. However, it's crucial to recognize that insurance and investment goals are distinct. For some individuals, separating insurance and investment strategies may offer more clarity and control over their financial planning. This really isn't an argument. It's just kind of a statement made in juxtaposition to a list of reasons supposedly you shouldn't buy whole life insurance. Now, I've been around the industry for some time, and so I do kind of understand where Chat GPT is going with this, and I also have an understanding of where this information is coming from. There's certainly a number of financial bloggers out there who have fancied the idea that insurance and investing don't go well together and you should keep them separate. As far as the claim that this can bring you greater clarity and control over your financial planning, I don't know why that would be, and there's no evidence offered up by ChatGPT to even explain what that means to us. But I know that we've been in business for well over 10 years selling life insurance policies, whole life insurance policies, in fact, to hundreds of people who house tens of millions of dollars in these things. And I don't think it would be their claim at all that their life would be more clear and less complicated and easier to control if they didn't own whole life insurance. In fact, I think the total opposite would be true. And we know from industry data that there are tens of thousands of whole life insurance policies in existence, potentially hundreds of thousands, actually. And the tendency to cancel a whole life insurance contract is lower than it has ever been in recorded history. People buy these things and they like them. The punchline of this whole story is simple. Chat GPT has a way of surveying information found on the internet and coming up with answers when you ask it questions. And it's very clear here that the information that is available on the internet regarding whole life insurance is generally pretty bad, because the arguments presented are false in many cases and really not arguments against whole life insurance at all. If you want to buy term insurance because you have a temporary need for life insurance, that's why the product exists, and you should do that. But that all on its own is not a reason to skip over whole life insurance. There shouldn't be any argument that the rate of return of whole life insurance will be less ultimately than buying stocks, for example. But there are lots of things that whole life insurance brings to the table as a risk mitigation tool that stocks will never be able to afford you. Putting the two of them together can accomplish some amazing things. The product is different, but it's not particularly complicated. You just have to learn the jargon in order to get comfortable with what's going on. And it is an extraordinarily versatile product that affords incredible flexibility to changing financial circumstances. If you want to know about how whole life insurance can help you, check the links below, reach out to us. We've done this for years and we can help you too. Thanks.